And good evening, everybody. Welcome to another edition of It's iBUG's Life, where every fourth Thursday or most fourth Thursdays, we kind of go over some ideas and tricks and tips for you to be able to independently do things without having to use vision. But today we're going to do a little different twist. But before we do enter that, we're going to before we get to find out who's all in the room tonight, I'm going to actually bring on the iBug guy. We're going to go over probably some just quick, brief announcements of things that's happening on the iBug platform. So, Michael?
All right. Thank you, George. Yeah, everybody. Glad you could be here. So we got coming up this next week, we've got tomorrow night, 8 o'clock p.m. is our regular iBug virtual movie. The movie will be The Accountant, starring Ben Affleck. And I can't remember her name now. Anyway, but it's a 2 hour, about a little over 2 hour movie. And the movie will, like I said, start at 8. You can come in early for the pre-movie social time starting at 7. We'll play some little games, name that tune, and some other games, tell some jokes, and just general shenanigans there. Then after the movie, we'll have a discussion, critique the movie, and some trivia. Then Saturday, 2 p.m. Central Time, all the times I'm saying our Central, is our iBug Apple Workshop. That's where we talk about all things Apple. And we have we'll have a couple of app demos, look at the past month's Apple News rumors, and then any extra time we might have, we'll be opening it up for just general questions related to Apple products. Then Monday is our regular iBug Buzz. That'll be Monday at 7 p.m. And again, all of these events are on this same Zoom conference that you're logged into or called into right now. Tuesday will be iBug Mac Buzz at 5 p.m. That's just a shortened version of iBug Macintalk. That's all things related to Macs. Open Q&A help session there for an hour. And Thursday will be the Trekkie Talk first. Oh, no, sorry about that. Next week, okay. Next week will be the Trekkie Talk first Thursday of the month. We'll be jumping into August. And I don't know what episode. I don't know if Jody is here or not. She'll tell us what episode if she is here and when she does her introduction. So that's what's coming up in the next week. Lots of fun things going on.
It is here about the episode is 13 and 14.
Oh, very good. Thank you. So, yeah, that's season 2. The only other thing I need to say, because we are going to be discussing financial related things, give a little disclaimer that this session is for educational purposes only, and iBug does not endorse any of the statements made, and they are the speakers, and they are the speaker's own information. The products or services that might be mentioned are not to be taken as financial advice, and that risks will come with any sort of financial endeavors. So, all right, with that,
Michael,
George, did somebody have a question?
Okay, thank you, Michael. Now, before we get started with the discussion of this month, what we like to do now also, the thing that we do all the time, try to find out who's all here. So what I like to do, everybody, if you can come off mute, say your name and the city and state that you are calling from.
Little Ferry, New Jersey.
Who's that from New Jersey?
Lisa G.
Hey, Lisa. Welcome.
This is Pete, and I'm from Florida.
Okay, welcome.
Louise, Lawrenceville, Georgia.
Louise from Georgia?
Yes.
Shazadi from Welland, Canada.
Who's from Canada?
Shazadi.
Shazadi? Did I say that right?
Yeah, perfect. Thank you.
Excellent. Welcome.
Florida and Kingston, New York.
New York, welcome.
Bridget, Atlanta.
I heard Atlanta, Bridget.
And Vincent from New Jersey.
And Vincent from New Jersey.
This is Ned.
Yes.
Ned from Texas.
Yes, Ned from Texas. And I want to give a plug to the talent show, iBUG Talent Show, on August 2nd, Saturday at 7 p.m.
Oh, crap. I forgot to put in my video. Oh, well. Too bad.
Thanks, Ned. Yeah, I totally overlooked that.
So did I.
Who else is here?
Randy, North Carolina.
Randy from North Carolina.
Dan from Southern California.
Who's from Southern California?
Dad.
Ted, okay.
Intisar from Iowa.
Iowa. Might be one of the few states that's not in the heat dome that everybody is suffering from lately.
Yeah,
Janice
we got
from Maryland.
Sorry.
Valencia
from Maryland?
Janice.
Janice from Maryland? Okay.
And Valencia from Maryland.
Okay. Welcome, Maryland.
All from Oklahoma.
Oklahoma's in the house.
Leslie from Mesa, Arizona.
This is from Mesa, Arizona. Welcome.
Louise and Barry from New Rochelle.
From where?
New Rochelle.
New Rochelle? Where's that?
Yeah.
Say it again.
New Rochelle, New York.
Oh, New York. Okay. All right. Okay.
You must not have watched the Dick Van Dyke Show.
I did, but I thought they were in Minnesota. Oh, is that?
No, that was a different show.
Oh, okay. Okay.
The right theme song.
Who else is here who haven't had a chance to introduce themselves? Say your name and the city and state that you're calling from.
Tim in Fort Wayne, Indiana.
Fort Wayne, Indiana. Used to be GW Micro's place.
Yes, and I've been by there several times, and I know people that used to work there.
Okay.
Hi, George. This is Rosetta Stone from Conyers, Georgia.
Rosetta Stone. I'm still learning languages. No, I'm
Go
sorry.
ahead.
No.
I digress. Welcome.
Hi, George.
Stranger?
Hey, you. What's up? No, I'm just kidding. This is Elisa in Porter, Texas.
Welcome, Melissa.
AKA Stranger, because he calls me that, and he needs to get a hold of me.
Okay. I was going to say something, but I'll refrain. All right, who else? Anybody else that not get a chance to introduce themselves? Say your name and city and state that you are calling from.
Latinia. I'm Latinia from Atlanta, Georgia.
Atlanta, Georgia. We've been bombarded by Atlanta today.
Yeah, with the peaches.
And Michael in Texas.
Okay. Anybody else?
This is Jane, San Diego, California.
San Diego, California. Home of the chicken.
Yes, years ago.
Years ago, exactly. They fried him up now. Anyway, who else? Who the other person?
This is Rita from the state of confusion. No, really, the state of Illinois.
Illinois, okay. Anybody else?
Hi, Julie from Rochester, New York.
Rochester, New York.
Yeah.
Look, we dominated by New York, Maryland, and Georgia.
Barely.
All right, last chance. Next 10 seconds. Anyone else who has not had an opportunity to introduce themselves as of yet? Okay, hearing crickets. All right, and my name is George. I'm like Michael. I'm here in Houston, Texas, where we get up to about 98 degrees today. I was out there in it, making field visits today, so the heat is definitely here. Um, so thank you guys for chiming in tonight. Tonight we're going to have a real good topic today. He was here during 1 hour sessions last year as well. So he gave us a lot of information. And matter of fact, he probably could have gave us a whole lot more. But, we limited to 2 hours. So we decided to bring him back, and glad he is taking time to grace us with his presence to provide all information regarding finances and investment. Darryl Ochsner is somebody who's been in the financial atmosphere for over 30 years, teaching classes. He actually even also have a radio program on the ABC radio where, he discusses investments and all kind of portfolio information. So Darryl is calling us in. He's from Tennessee. So, and without wasting any more time, I'm going to go ahead and pass the mic over to Darryl Ochsner, who's going to be discussing anything dealing with investments and finances, and he is be happy to take questions for the. I do want Darryl, before you speak, let me just give one particular house rule that we failed to mention. If you are in the area that has background noise, we're going to ask that you either move to a quiet area or go on mute. If you're calling on the phone, hit *6. If you're on your a smart device like an iPhone, Android, then just find your mute button. Or if you're on a Windows computer, I think it's Alt-A that will mute you in Zoom. And if you're on an Apple device, I think it's Command-Shift-A. So stay muted, and if you have a question that you might want to ask or make a comment, then you can come off mute, say your name, but wait to be recognized before you start speaking. So that's all we have. Okay, now, without further ado, Darryl, I'm passing you the mic.
Thank you. I am glad to be here, and I am glad to see so many different people from so many different cities and states and even countries here tonight. So I am thrilled that all of you guys are interested not only in maybe investing, but even if you're here and let's say, well, you don't know or understand or even care about, let's say, ETFs, which are exchange traded funds. Maybe you just have financial questions on your own situation and something that you're dealing with. And please feel free to stop me at any time to ask questions that relate to your situation, because just like the purpose of iBUG, I am here primarily to help you. Honestly, helping you is my number one concern. And you say, well, what if I don't get enough information from the presentation? That's okay. There's tons of days ahead in the future. We can go over anything, but I mainly want to help you in your present situation, whatever challenge with finances that you're having. So please don't feel shy. Don't feel bashful. Just speak your name and George can call on you. And remember, I'm here primarily to help you, to be your guide, to be your servant. So that's what I want to be. I love having discussions about a topic. I can present my background and what I have seen over the last 30 or so years of investing, but you might have seen other things. And so feel free to bring that to the table. Now, what I first want you to do before we dive into the actual investing, or ETFs, remember that stands for exchange traded funds, what I want you to think about first is, how do you create a big snowball? Now, in our current heat, that's very unlikely, but pretend with me. Pretend it's the winter months wherever you are. And so think about the steps. What would you need to do to create a big snowball? And for this, George, if you don't mind, I don't mind if people just shout out an answer. What would be something really needed to create a big snowball?
Yeah, that's fine. You guys can come up and we can just throw out some answers.
Anyone? Don't be shy.
A little snowball.
A little snowball. Okay.
Ice.
Ice. Well, okay. Yeah,
a lot
snow
of flakes.
and ice.
A lot of snow, yeah.
Yeah, a lot of snow. Okay. Any others? Come on.
Cold weather.
Cold weather. Yes, that would definitely help, especially today.
A steep
Okay.
hill, roll it down.
A big hill to roll it down. Yeah, that's definitely important.
You would need time.
Time. That's a good one. What else?
Roll a little snowball in the snow so that it can get bigger.
Yeah, a little snowball and it gets bigger and rolling it down.
Gloves.
Any others?
A way to keep it from melting.
A way
so that you can exploit it.
Yeah, we definitely wouldn't make a snowball in today's climate, probably. But yeah, what are some others? Any others?
Money.
Money to create a snowball? Okay. Wow. I'm unfamiliar with that concept. Okay, what else?
The right kind of snow. All snow doesn't make snowballs.
Absolutely. Yeah. Snow that actually sticks and clumps. Perfect. Now, that is a snowball connoisseur. Okay. Any others? You guys have said a lot.
I'm going with hands.
You're going with hands to make the snowball?
Yes.
Yeah. That's definitely important. Okay. One thing, and you guys, some of you kind of hinted at it, but you didn't specifically say it. So just in case you thought about it, but described it different, is, well, pretend you're in your house and let's say there's lots of snow and there's big hills and, the snow is, it's all the way up to your neck deep. But let's say you stay inside your house and you say, well, there's a lot of snow out there. I bet I could create a snowball, but you just stay in your house. So this is one problem that I've seen with investing is people, they say, oh, I want a big account, a big investment account, or I want a big retirement account or a non-retirement account. But the number one thing that they fail to do is ever get started. And you say, oh, well, of course, that's so basic. You would be surprised how many people fail to even start. Oh, but wait a minute, let me come up with an excuse of why I can't start. Well, yeah, there's a lot of excuses people have used over the decades that I've been doing it. Just a few weeks ago on my ACB call that I do 2 to 3 times a month, one of the hosts I had said, oh, well, I can't ever do investing because it takes lots of money. And I said, well, how much money do you think it takes to get started? Oh, I don't know, she said, but it must be a lot. Well, the answer is $1. Literally, you can get started for as little as $1. What? You can get invested for just $1? Yes, you can get invested for literally 100 pennies or $1. And a lot of places now, a lot of brokerage companies have what they do not charge commissions. Basically, it's commission free. So there's back in the old days, for any of you guys and ladies who have been around and knew, oh yeah, there used to be commissions. Or even if you're using a brokerage company, let's say, that have commissions, there are multiple large, well-known companies that give commission-free trades, whether that be on stocks or ETFs, etc. And on top of that, some of them let you buy either some ETFs, all ETFs, or even individual stocks for increments as low as $1. So never let the excuse, oh, that takes a lot of money. Okay. And granted, if you have reasons why you think that you can't invest, just feel free to say, hey, ask me. You can say, well, what about this situation? And I will try as best I can to see if we can't solve whatever situation you're facing. Okay, so that's my analogy of not only building a snowball, but also getting invested. Now, some of the other things that you guys mentioned, well, after you get started, yes, you do start with a little bit of snow. And of course, yes, you do need the right temperature. And yes, you do need what you do, hands. Someone mentioned hands. You first have to put the effort into making a little bit of a snowball. But then once you form a little snowball and let it start rolling down the hill, and granted, time, one person mentioned time. Time is a very big factor. The more, or I should say, the less money you have to invest, the more critical is that you have time. So you say, when's the best time to start investing? As soon as you can, if not yesterday. So if you start, it's the same answer for planting a tree. When's the best time to plant a tree? Well, the best time is 20 years ago, because then you would have a nice shade tree or use it for swings or whatever. But planting a tree today or starting invest today is always second best if you've never started. But yes, time is a huge factor. And another thing that I don't think anyone mentioned, I apologize if they did, but after the snowball starts rolling down the hill, think about this. What if I kept stopping it? If I kept throwing things in the way and said, oh, I want the snowball just to go 5 feet and then stop. Well, that's not beneficial. If you start that snowball and let it start rolling down with time, if you get out of the way and let it do its thing and grow, that will give you the best results, not only in a snowball, but also with investing. Okay, I'll take a pause just for a few seconds. Okay, and by the way, I'm taking the pause because I don't want to feel like, oh, I don't want to interrupt him. I want you guys to ask questions, whether it's on ETFs or your own situation. Okay. Now, on ETFs, how long have ETFs been around? Well, would you believe, over 30 years? The first ETF came out basically in January of 93. It was developed in 92, but basically it was available to the public back in early 93. And that basically was the S&P 500. Okay. And the company called State Street came up with that ETF. And what it was, okay, first let me explain what funds are in general. Let's first start with an individual stock or an individual share from a company. Now, a company, and you can pick any publicly traded company you can think of. It can be in the US or Canada or Japan or Europe. It doesn't matter. But basically, a company, especially one that's publicly traded, it divides its total value up into what are called shares, or some people just say stock. Okay. And by the way, stock, that's a common name, but actually stock, if you really want to get technical, is actually called common stock, because there is a thing called preferred stock, which works completely different than what most of us just call stock or equity. Okay. So let's say we have a big company and it has 1 billion shares. Okay. Basically, what that means is if you own one share, was that somebody asking? Okay. If you own one share of this company that has 1 billion shares, then you basically own part of that company. Now, it's not a huge percentage. It's one billionth of the company, but whatever that company is worth completely, if you take 1 billion pieces, you own one of that. And of course, as you buy more shares, then yes, you would own more and more percentage of that company. Well, here's a problem. Let's say I have money, but I only have enough money to invest in one company or 10 companies or 100 companies. Yeah, that's possible to do, but you have risk of lack of diversification. And what that means is the more different types of things, different types of companies or bonds you hold, the less risk that you face or your portfolio faces. Because let's say 5 companies do really well, or on the other hand, let's say 5 companies do really poorly. If you had 5 or 10 or 50 other companies that were all doing good, then that would help your portfolio. And that's basically what either a mutual fund, which is an older sibling of the question.
There is your portfolio, basically like your total assets.
Yes.
Yeah, that's what another word is for that.
Yes, I'm sorry. And that's good that you asked. Portfolio just means this is your collection of whether it be stocks or bonds or mutual funds or exchange traded funds. Everything put together in one big pot is called your portfolio. Thank you for making me clarify that. Now, so the thing is, when you invest in individual stocks, and granted, that's been around for several hundred years, buying into or investing in individual stocks. But the problem with that is, well, you kind of lack diversification, because let's say even if you own 50 different companies, and that's a lot, but let's say you have 50 and though 25 or 30 do poorly, Well, that's hard to do good when half or more of your portfolio is doing poorly. And it takes a lot of time to manage 50 or 100 or more companies or bonds. So back in the 1920s, I believe, they, place out of Massachusetts, created the first publicly traded mutual fund. Now, what is that? Well, basically, that's where people, like, let's say all of us here on this Zoom event, let's say we put all our money together. So we had a big sum of money, and then we handed it over to a company called a mutual fund company. And with that big sum of money, now instead of just 50 different companies, they could buy, let's say, hundreds of companies. Okay, and that's what pretty much was going on for most retail investors from the mid to late 20s all the way up into the early to mid 90s. Okay, until the ETF came about, the very first one. And okay, well, what's an advantage of an ETF over a mutual fund? Well, on mutual funds, basically, one thing is most mutual funds, not all, but most, especially in the first few decades, were managed. And what that means is you, as the investor, are basically paying a person and his or her staff trying to do better than a measured thing called an index. An example of an index is, let's say, the S&P 500. Okay, so the S&P 500 is 500 large companies in the U.S., and so a managed fund, basically, you pay part of a manager and his staff and his computers and his lighting and his utilities and even advertisement to get other investors interested in that fund. And so what's the internal fee or basic, now you don't see the internal fee that they charge you, but that's called an expense ratio. And what happens is throughout the year, the manager is removing money or gains, what should be yours, and they're using that to pay their salary or their other employees' salaries or the bills, etc. So back in the mid 1970s, a company by the name of Vanguard out of Pennsylvania decided, we think retail investors want not a managed fund, but an index fund. That means you don't have to pay for a manager to try to pick stocks or the staff or all this other stuff. Basically, we let the companies who create the indexes, we'll let them decide who the 500 is, for the S&P 500. There's other indexes, but we'll let them decide on the list and how much of each company is in that list. And then all we have to do is, have our computers program basically to have that much of each company in the index. Okay. And just for anybody curious, that's called a market cap weighted index. And basically what the advantage of that was, well, number one, instead of a high internal cost known as an expense ratio, now the fee or the cost was significantly cheaper because you're not having to pay for humans to do all this research. You're basically just paying a decent sized computer to buy and sell the stocks as needed. That was one advantage, a lower expense ratio. Okay. Now, another advantage, as I mentioned, individual stocks versus mutual funds. Mutual funds, you're investing in a pool of different assets. So therefore, let's say if you had $100 and you put $100 and you wanted to buy back then, if you wanted to buy the S&P 500 index fund, with that $100, you would automatically be invested in 500 different companies immediately. Okay. And not only that, they would have already decided how much money allocates of your $100, how much money gets allocated to each company, because it's not equal. The bigger the company, the bigger the percentage that was in the index. Okay, and that worked pretty good. Now, the thing that existed from about the mid-70s up till more recently is, let's say you want to buy shares or sell shares. And this is especially true in a non-retirement account. But let's say that all of us own shares of a mutual fund. Okay, it doesn't matter which for right now, S&P 500 or a managed fund, it doesn't matter. When one person sells shares, what you're really doing is you're interacting with the company that owns that mutual fund. And what the manager has to do in order to give you cash back is he or she has to decide, okay, now which company shares, which companies do I want to sell in order to give you cash? Well, what that does now for the person who's leaving, that's great. And that's fine because they get their money. But what about all the rest of us? Well, when a manager sells individual companies inside the fund, remember, it's called a mutual fund. And when you sell individual shares, that creates a taxable event. So all the rest of us, even though we did not sell any shares, we, at the end of the year, have to pay the taxes on what one person or multiple people did when they sold out. Okay, that's what happens in a mutual fund. Now, well, is that better with an exchange traded fund? Absolutely. That was one of the problems that an exchange traded fund fixed. So now when a company has, again, we'll pick the S&P 500 because it's simple. They have these 500 companies. And now instead of you going to the company or the provider, that's just another name for, say, the mutual fund company, and saying, I want to buy shares or I want to sell shares, you're actually buying between the rest of us. You're buying or selling from the rest. So let's say if you're buying shares of the S&P ETF, well, really, you're not going to the company that provides that in ETF. You're actually buying it on the secondary market from another investor, say one of the people in this room. So they're selling and you're buying. And you say, well, okay, does that help? Well, yes, because when that person sells you the shares and they sell out, they are not having to go to the company. So the manager really doesn't know and doesn't care who owns the shares because to them, there's no taxable event. They don't have to sell the shares internally. So that means all the rest of us who neither bought nor sold, we don't have to pay the taxes at the end of the year. And that can be a very big issue, especially in non-retirement accounts. and especially in volatile markets, such as 2000. Now, I know that's a long time ago, but there were mutual funds that were paying 50% or more as distributions after they had lost 50% or more of their balance. Let me take a breath here and see if there's any questions so far, any thoughts or anything.
No, this is George. I have a question.
Okay.
And you guys, if you guys got a question, don't let me dominate the audience. But how, let's say somebody has, like you said, S&P 500, which is a bunch of different companies.
Right.
Somebody might want to liquidate a certain amount of assets. How does their person decide which shares to sell to produce the cash flow that they need? Like if somebody has a certain amount, they might want to just have like 200. How do you know which shares to sell? How do they decide which ones to sell?
Are you talking about just shares of the S&P 500 ETF?
Correct.
Okay, good. That's a good question. And the answer will depend on if it's a retirement account or if it's a non-retirement account. In a retirement account, such as an IRA, a 401, a 403, and by the way, Canada does have symbols, but I've forgotten the symbol names right now. But basically, the concept is the same. In retirement accounts, all shares are considered equal. So therefore, in a retirement account, when you sell a share, you do not have to identify which share, because all shares are equal. All shares are fungible. One is equal to another. In a non-retirement account, and this only applies to non-retirement accounts, there, each share you bought has a different price that you purchased it at. And so for tax purposes, there are several different ways to identify shares. One example is, and this is very common, especially for mutual funds, it's called first in, first out, or FIFO. And what that literally means is if I bought 50 shares, let's say, every month of this ETF or fund or stock, and then I want to sell, say, 10 of them, well, when you sell those 10 shares and you're using first in, first out, it would automatically go to that very first month that you purchased, and it would sell 10 shares from that purchase. Now, that's first in, first out. There is also another called HIFO, highest in, first out. What does that mean? Well, that means, let's say you've bought this fund or stock multiple times, and each time you bought it, it was at a different price. Sometimes, let's say the price was well below $50, and other times you bought it, it was well above $50, and now you're wanting to sell it exactly for $50. And you say, well, if I use HIFO, that means the company is going, my brokerage company is going to take the shares that you paid the most for and sell 10 shares of that. And you say, well, why would I want to do that? Because that is known, at least in the U.S., that is known as a capital loss, and you can use that to lower your tax bill. Not only can you use that to decrease anything that you sold for gains, but you can also use losses up to a certain amount to lower your regular income, such as, let's say, if you have a job or Social Security or pension or dividend interest from bonds or CDs or any of that, you can use losses to lower that, to make it kind of disappear. So now the government says, oh, we'll pretend you really didn't make that money, so that means you don't have to pay tax on that. And if you use that consistently over time, that is a big help on your taxes. Okay, go ahead?
This is Claudette. So if you, I'm trying to make sure I understand the difference between the mutual fund and the exchange
traded fund.
So let's just say I have $1,000.
Okay.
I want to invest it. Do I look for a mutual fund or do I look for an exchange traded fund? Do I have to worry about how many shares that is? Or can I just say, like Merrill Lynch, say for a company, do they have an exchange traded fund? And I say, hi, Merrill Lynch, I want to buy or I want to invest $1,000. What do I do now? How do I do this? Or
Okay. Now, for instance, both options are available to you. I mean, literally, if you wanted to, say if I said, well, I recommend certain ETFs, and you said, no, I don't want to do ETFs. I want to do individual stocks. Okay, that option is available to you. Or if you said, well, even though that guy said exchange traded funds, I don't want to do that. I want to still do mutual funds. Again, that option is available to you. Mm-hmm. Now, what I generally recommend are exchange traded funds, and not just all exchange traded funds, unfortunately, but certain ones called indexed, and I'll get into that maybe later. But because the reason I recommend exchange trade funds, number one, the internal fees are very, very low. Okay. And that's not the case with, say, most mutual funds, because most mutual funds are managed. So you're paying the company for all their staff. Oh, and here's one other bad news for managed funds. Over the course of, say, 10 years, over 90% of managed mutual funds and individual advisors fail to beat or even meet the index. Oh, well, if 90% can't even equal the index, why can't I just buy the index? Well, the closest you can get is an index ETF. The expenses are low. The taxes, especially if you're dealing in a non-retirement account, are very little, if at all. For instance, I've had ETFs for 20 years or more, and literally there has not been any taxes on any of the shares I've owned with ETFs. I cannot say that of mutual funds that I had previous to that. So it's cheaper on taxes, cheaper on cost. And did you have a follow-up?
No, I think I just want to say thank you for your answer.
Oh, sure. Now, let me tell you. Go ahead.
Oh, I'm sorry. This is Rita.
Hey, Rita.
Hi. I just right where you are, right there.
Okay.
Warren Buffett with Berkshire Hathaway several years ago challenged mutual fund companies. He put up $1 million and he invested in low-cost index funds. And he had, a mutual company stepped up and put up $1 million. And over a 10-year period, they invested, and the mutual fund manager tried to beat, the index. And after the 10-year, there were some years where he was ahead, there were some he was not. And after 10 years, though, he could not beat the index fund that, you know, Warren Buffett invested in. And they, you know, they gave the money to charity, but it just shows you the money that gets sucked out from mutual funds because you're paying for them to be managed.
Yes, Rita, and thank you for that story. Let me modify it slightly.
Go for it.
Okay, now a mutual fund, she's right that it was a fund, but it actually wasn't a mutual fund, it was a hedge fund. And you say, well, and I wasn't trying to address hedge funds, but what hedge funds do are basically, let's say mutual funds kind of have to drive on the road. They have rules they have to follow. A hedge fund basically has no rules for the most part. They can pretty much do about anything they want. And yes, as Rita pointed out, Buffett picked the S&P 500 over a decade, and it greatly outpaced the hedge fund. And yes, the $1 million prize went to charity. That is basically showing not only that cost matter. Now, unlike the line you might have heard years ago, oh, it's what you pay for is what you get. In investing, it's what you don't pay for that what you get is what you get. There are two important things in investing. One is cost. Two is diversification. Your goal is to keep costs low and be as diversified as possible. Now, granted, could I do that with individual stocks? If I had 1 billion hours per day, maybe I could manage 20,000 different companies, but I might not even be able to do that in 1 billion hours a day. But I can buy 1 or 2 ETFs and they do it for me at a very low cost. Well, how much? Let's talk about the expense ratios. For instance, let's say I were investing $10,000 in, let's say, the total market. Okay, there are many ETFs, and I'll use Vanguard as an example because I mentioned them earlier. The Vanguard total market has between 37 and 3,800 different companies. That goes up and down, usually higher in boom times because more companies get formed. But basically, if it's a company in the U.S., then they're pretty much in the total market. So let's say if I had $10,000 to invest and I bought the Vanguard Total Market ETF, I would own, like I said, between 37 or 3,800 companies all at the same time. Okay. And the expense ratio, that means how much I'm actually paying the company to manage and buy and sell. You know, let's say if a big company buys a little company, well, then obviously that little company goes away. So to do all that, they would charge $3 per 10,000, or that as a percent, that comes out to 0.03% per year. And that is for the total ETF from Vanguard. Okay, well, let's say that's domestic. What about international? What about 98% of all the companies outside the U.S.? Okay, there I think, and don't quote me on this number, but I think the number is around 75 or so 100 different companies. That can vary, but it includes Europe, Canada, Central America, South America, Asia, et cetera, et cetera. So it's well above 7,000 different companies. They charge an expense ratio of 0.05%, which basically means to have them manage thousands of companies every year. You are only paying $5 for every 10,000 you have invested. And you say, well, compare that to, say, a managed mutual fund. I have seen, now more recently, managed mutual funds have dropped their cost a lot, but they go anywhere from 0.4. So that means, say, $40 per 10,000 or higher. I've seen mutual funds even not too long ago that were charging well above 1% or 2%, or it's silliness. And again, like I say, you could have that for 0.03, say, for the total domestic market, 0.05 for the total international market. Or you say, well, okay, that's stocks, that's owning companies. What about bonds? By the way, what is a bond? Does anybody know?
This is Julie.
Hey, Julie, do you know what a bond
Darryl, how are
is?
you? Yes, I do. It's like you're dealing with the company's debt, right?
Exactly.
So you're not owning it; it's debt.
Basically, and it doesn't have to be a company. Julie is absolutely right. It can be a company or a government or even an individual. You say, what? Individual? How does an individual sell their debt? That's called a mortgage. So anybody that has or had a mortgage, basically you were selling a bond. And yes, so let's take Julie's example of, say, a company, or like I said, a government. But basically, you pay the company money, and they're basically borrowing your money, okay, for a time, and they pay what's called interest, either twice a year or whatever the arrangement for that individual bond is. Now, a mutual fund or an ETF, remember the last letter of ETF is F, that's still a fund. So you're getting many, many different bonds in a bond fund. So just as an example, there are bond ETFs. Some are called, let's say, the total bond market, or the total international bond market, or let's say, if you want more specific, the corporate intermediate term bond market. You can get those with ETFs. Okay, so and the expense ratio is rock bottom. Usually it is under 0.10%, which means even if you have 10,000 invested, what your cost is. Now, remember, on expense ratios, you don't see this. This is not a line item where you're actually going to see it. This is simply reflected in the price throughout the year. But for $10,000, an expense ratio of 0.10 is basically $10 per every 10,000. And like I said, Vanguard total market, the domestic total market, that's only $3 for every 10,000, or the international equities stocks, that's only $5 for every 10,000. By the way, throwing out these numbers in case anybody gets tripped up by the numbers, please stop me and say, hey, I didn't get that number. Explain that again. So I understand if I'm throwing out numbers. Sometimes numbers get confusing. Okay, let's see. What else? Okay, I've already mentioned. Okay, yes.
I'm sorry. Just when you're ready, this is Julie speaking, and I have a question for you.
Yes, ask.
Okay, thank you.
Serving you is number one.
Thank you. So my question I was going to ask you was that I'm familiar with like the index funds, right? You can only buy and sell those at closing, right? When the markets are closed.
For mutual funds, yes, not for
Okay,
ETFs.
Right. I was just going to ask you that. So like an ETF, if it's where you can buy and sell whenever, do you have to like watch it? I mean, is that kind of like you would if you're doing a trade?
Okay, and this is another advantage. And Julie, I'm going to get I'm going to give a longer answer because I'm going to introduce that concept right now to everybody. But if I don't specifically address your question, then let me know. Okay, basically, another advantage of exchange traded funds as opposed to mutual funds. Well, mutual funds, hey, they were good because, now you're owning many different companies or many different bonds. But, well, there was individual stocks and we could trade those throughout the day. We didn't have to wait till the closing before we bought or sold the mutual fund. Well, stocks you could buy and sell throughout the day. Well, the exchange traded fund, you are allowed to trade it just like a stock. Okay, so literally, if you, for whatever reason, like to buy at 10 a.m. in the morning or 1 in the afternoon, you can buy exactly at that time, or you can sell exactly at that time if you want to, with either individual stocks or exchange traded funds. Exchange traded funds buy or sell as long as the market is open. And so you literally not only see the approximate price that you're going to buy or sell for, but there are certain things you can do with stocks or with exchange traded funds. If you said, oh, I want to buy this fund, and I'll go back just to the S&P 500, but keep in mind, I'm just using this as an example, not as saying, oh, buy this one. Let's say if the price were $200 and you said, well, I like the S&P 500, but I really only want to pay $198 for it. You can do that. You can do that with a stock. You can do that with an exchange traded fund. You cannot do that with a mutual fund. A mutual fund, if you say put in an order at, let's say, 10 a.m. in the morning, well, do you get the price at 10 a.m.? No. You do not get the price until the end of that day. And that's the price you get for a mutual fund. An exchange traded fund, you'll get the price right in that second. Or, as I said, you can do and I'll throw this out. Don't worry about this word. It's called a limit order as opposed to a market order. And what a limit order is, like my example, if I said, I want to buy that thing, but I only want to pay $198. I don't want to pay $200. And you can do that. Or many brokerage companies, they'll allow you to buy in dollars. Now, I'm going to throw out one example because on my ACB calls, I often say the products, meaning the exchange traded funds of Vanguard, are very good because they have low expense ratio and they're very diverse. But the customer service is actually better with a company out of Massachusetts called Fidelity. And so literally what I tell people in my ACB calls, I said, you can set up an account for free. It doesn't matter if it's a IRA retirement fund or a non-retirement account. You literally can set up an account. You say, how much is that? $0. It doesn't cost a single thing. But what I tell my class is when you buy ETFs, try, if Vanguard is competing in that space, that means, let's say if Vanguard issues an ETF, such as the total market or the S&P 500, Vanguard built its whole business on being very inexpensive as far as the cost that you have to bear. So they are very hard to beat. Now, there are 3 providers in case you don't like Vanguard. iShares, they're based out of San Francisco, I believe. They're owned by BlackRock. Or the third one is State Street. Those 3 providers roughly represent, as far as dollars, about 80% of the market. And the market is literally trillions of dollars now for ETFs. But those 3 are the big ones. So if you can't find an ETF, say from Vanguard, usually you can find it either in iShares or ETF. You say, does that mean I have to go to another company? No, no, no. You still would have your brokerage account at the same place, such as Fidelity or wherever your brokerage company is. Now, Michael, yes,
I have a question when you're ready.
Yeah, I'm ready.
Okay, based on there's limits and then the
market.
Market. So let
Right.
me ask you this: if I have stock ETFs,
right,
I have ETFs, and let's say I'm worried it's going to go down too low, and I'm going to lose money because it's going to get if the stock market goes goes down a lot because
Okay.
I've been watching it and I see the lower end and where I bought it in the lower end. Would it be wise to put a limit on it so that I wouldn't lose a lot? Like, you have to do a few dollars. It goes up and down a few dollars, but I've been watching the low on it. So I see the low on it. So would I be, would it be okay to go, like a few dollars below what the lowest is just in case things like tanked as like an assurance? Or is that not a good idea? Because things go up and down. It's expected to go down. It's expected to go up. What's your opinion about putting an open limit that I know in Fidelity it works for 180 days. You can leave an open limit. So any day it goes low. What's your opinion about that?
Okay. First, now in that case, it's very similar what you're describing. Technically, they give it a different name. So for any of you investing junkies out here, it's not called a limit order in that case. It can either be called a stop loss order. Some companies just call it a stop order.
Mm-hmm.
Or in the company that you're with, for instance, they have a lot of different things, such as one is called a trailing stop loss, and that literally is the most flexible. But before you do that, let me give you another analogy. Let's pretend most of us have either been to the grocery store in our life at least once. I'm hoping. If you haven't, humor me. But let me ask you a question. Is it better to buy something when it's greatly on sale, or is it better to buy it when it's greatly overpriced?
Well, obviously when it's on sale.
On sale.
But I'm just saying, should there be like if it was say 100, right? You bought $100, and let's say it was going to go down. See, this is the question I get stuck on, because if it goes down to 51, but a stop loss, but then you're selling it when it's at the lowest, when you want to, when you want to buy it at its lowest. So is it better to not put a limit on it and to pay attention to it, and when it's at a low point, then just buy more of it?
Okay, what you're thinking about instead of investing is really commonly more associated with trading.
That's where
Now,
I'm confused.
a lot of people innately, when we come to the investing table, and trust me, about close to 100% of people do this, they want to call themselves investors, but mentally they are actually traders. Okay. And we all come to the investing table. We think we're investors, but until we learn how to properly invest, we innately, our thoughts are really those of traders. Now, for individual stocks, and I'm shifting out of funds and going to individual stocks for a minute. Let's say if your example, you bought it at 100, now it's dropped to 50. An individual stock does have the possibility of literally going bankrupt and being worthless. That's an individual stock. Somebody asked me the other day, well, what about an exchange traded fund? For a diversified ETF, such as the S&P 500 or the total market or the international, literally, let's again take the S&P 500, literally for it to go to zero, all the 500 most commonly held companies in the U.S. would have to be bankrupt. If that's the case, you're going to have bigger problems than your share price. Okay. So, we're talking Armageddon, nuclear war, etc. I don't know. But an index is always, and they even, let's say if a company does, I think it's once a quarter or twice a year, one of the two. Let's say if a company does get lower, an index provider follows the 500 most commonly held companies, and they can sometimes replace one or two, usually not very many, with, say, an up and coming star. Okay, I can give you one example. Several years back, the company Tesla, okay, you guys know that they make electric vehicles. Even though they were a large company, they were not in the S&P yet. Now they were in the total market, but not the S&P, because the board had not decided this for the S&P 500. But outside the S&P, by far, they were the biggest gorilla in the room. And so the next time the committee met, they added Tesla to the S&P 500. And of course, Tesla was already equal to in the top as far as size. So back to your question, is it better to sell when something is low? Usually, well, again, this comes down to preference. I do not do that as an investor because there's a basic common line that says buy low, sell high. Many of you guys have probably heard it, except in the heat of the moment when we're investing, i.e., almost thinking more as a trader, we're thinking, oh no, I'm losing money, so I'm going to sell out. And that's very common with beginning investors, which are, again, you want to label yourself an investor, but in your head, you're really a trader. And that can change over time. Emotionally, let's say if that happened, okay, and when's the last time that happened? Probably in 08, 2008, 2008, how many ever years that is, 17 years ago. There were many stocks and even indexes that dropped maybe, say, by 40 to 50%. So yes, at that time. Now, because we have the advantage of seeing into the future after 08. Now, see, people back then, they couldn't see the future. And a lot of people said, oh no, I'm losing money. I'm selling out. And so many people sold their investments. The smart people, realizing they would much rather buy things on sale than at elevated prices, bought all during 08 and the beginning of 09. Now, 17 years later, many of those things have gone up exponentially from back in 08. Does that make sense, Lisa?
Yes, yeah, that's why I'm afraid. Because if it's low, well, you want to buy low, but Yes, I understand that. Yeah, because I
Yes,
have been seeing this.
if you're dealing with individual stocks and it starts dropping, the number one thing is you have to really be on top of that, and you have to ask yourself why it's dropping. And that takes a lot of research, especially if you have a lot of companies. For an index, me personally, I'm buying several times every week. And you say, well, what do you decide to buy? I look at between stocks or bond, and remember, it's ETFs when I say stocks and bonds. I'm looking at the area, whether it be domestic or international or real estate. And those, by the way, can be in ETFs or fixed income, which is bonds and preferred stock. Whichever one is the lowest, i.e., the biggest one on sale, that's what I'm going to buy because I've been through many recessions, including '08 and '01 and all of those things. The best time to buy. And academically, you'll say, oh, this is easy. Yeah, of course, I know to buy. Emotionally, it's probably, especially in the beginning, going to be one of the hardest things you do. And I had a older client, and he kept saying, oh, I'm throwing good money after bad. And especially in the later years of his life, he academically knew what to do, but emotionally, it was very hard for him. And, but yes, for all of those that buy at low prices on sale, eventually whatever's low goes up, and
Yes.
eventually whatever's high comes down, at least in the short term. So just as an example, in the US, our market kind of dropped when we had the news of tariffs that rolled out. So in April, I was buying equities, especially domestic equities, because everything was on sale. But a lot
Let
of
me ask you
people
a question.
go ahead.
Thank you. When you say on sale, give me an example. Like I've been watching some stocks, and it's like a couple of dollars, and then one is like now it's like $6 maybe, higher or lower, higher. But one, the other one is like when you say it's on sale. When you're talking about one stock, what are you talking about? Like it goes
Okay,
from like 80 to 78, or are you talking about
no,
like 80 to 70?
no. I'm not even talking about individual stocks. I'm talking about baskets.
Well, yeah,
So,
and an ETF, I'm saying the ETF, and it says,
uh-huh,
the ETF says it's like what is it, the VXUS or something
right.
went down a little bit, and it was like $72, let's just say. So it went down a little bit because it was a little higher. So when you say it's on sale, how much of a sale, and to get a perspective, I'm trying to get a perspective
Okay,
when you say
right,
on sale. Do you mean
right.
like $2, $3? Do you mean like
No,
$10? What do I'm just trying
none
to
of
get an
that.
idea of what you mean.
Okay. Here's how
In
you
the ETF,
right.
I'm talking about.
Let's just use 3 ETFs. Okay. And I'll say I have one ETF that's all the domestic stocks, one
Mhm.
ETF that is all the international stocks, and one ETF that are bonds. Okay.
Mhm.
And let's say I put each of those representing my portfolio for 1/3.
Yeah.
Okay. Now, so each one is 1/3. Now, how do you decide which one is cheaper or a better value than the other for
Oh,
a
so you're only
long-term
looking at.
investor?
Okay.
Say it again.
No, I'm, you know what? I didn't realize it, but my brain was going to trading and not investing. So it's taken you a while
Right.
to get into the
Yeah,
fixed stuff. So
that's
now
very
I'm
common.
understanding because you told me, you said it just matters about the division. What do you have more of? If you have more of one, you want to try to build up your lower one. So whatever's
Yes.
lowest. But
So,
so if it's the lowest one, you want to get that when it's low. You don't want to buy that when that's high.
right.
Okay.
But emotionally, it's much easier to buy the thing that you see has been going up Because, oh, hey, it's been going up for 6 months or a year. Oh, surely it's going to go up tomorrow. Well, stocks and bonds are not like the sun. You can't say, well, the sun rose today. It'll probably rise tomorrow. Stocks and bonds do not work that way. Eventually, markets get overpriced, which they might be now. Okay. They might, but you say, well, can they keep going up? Yes, for a little while. They might continue to go up, but it's kind of like musical chairs. Eventually, the music's going to stop and somebody's not going to have a chair. So the best thing to do, back to my example, let's say you had 3 equal parts of domestic equity, international equity, or stocks. Sorry if I confuse anybody by saying equities versus stocks, and bonds. And so whichever, let's say if the 2 stock ETFs are going up, remember the 3 of those things, the first ETF, the second ETF, and the third ETF, always have to equal 100%, because basically that's your portfolio. Your portfolio is always equal to 1.0 or 100%. So as those other things go up, percentage-wise, the third thing has to go down. Maybe not in price. Let's say all 3 are going up, but they're going up at different paces. It's kind of like a foot race. If the first 2 are running faster, even though the third one is still moving forward and running, that third runner is not moving as fast. And so therefore, in the long term, it's probably a better deal. Now, this is not stocks. Remember, get your mind off individual stocks. We're only talking about broad baskets here. Okay, so yes, if you buy what is the laggard as far as broad baskets, that is one way to help keep your balance or keep your portfolio in balance without what they call rebalancing. And let me define that term. What rebalancing means is literally you would sell some of whatever's done the best and you would buy whatever has done the worst. That is rebalancing. Okay. But you say, well, if I'm in a non-retirement account, that might produce taxes, which is true, even though it would help your portfolio. But let's say if you want to try to avoid that, well, what you can do is with any new money, always keep buying what is the smallest percentage of the pie or of the total. Does that help?
Yes, yes.
Just signed one crazy 70 something mil a year. AE got one, like these Supermax deals.
Could you ask that question again? Oh, okay. Anyway, any questions at the moment? Okay, everybody silent. Please say I didn't put everybody to sleep. Okay. So you want, now, as I said earlier, we have a broad basket, not just, let's say, of domestic, but you would also have international. You would also have fixed income or bonds. Preferred stock is also part of fixed income. So that's why I kind of just say fixed income, but bonds is a big part. So you could have at least those 3 categories, and literally for $3, let's say over at a place like Fidelity, you could have $1 in the Vanguard domestic ETF, $1 in the international ETF, and $1 in a bonds, and there's multiple different bonds. But you could pick an ETF in those 3 categories, literally $1 a piece. So you literally could own roughly about 10,000 different companies and literally have over 10,000 different bonds, all for $3. Okay, so that's how low, how much little money you need to be an investor. Okay, so the excuse about, well, I need more money. No, literally, you can start at any time. Now, granted, if you have more money to start, I'm not saying start necessarily at $1 if you have more, but don't use the excuse, oh, I don't have enough money, because that just means you won't ever get started. Okay, let me take a breath.
Okay, just a quick pause,
George?
everybody. We got Darryl Ochsner. He's talking investments this week on this version of his iBUG's Life. And right on second question, Darryl got another question. I'm gonna use like a real example. I have like a little small amount in a Robinhood.
Okay.
And it'll tell me there's one figure that says amount earning interest and amount buying power. And those figures are the same thing.
Right.
What's the difference between what is buying power? What is amount earning interest? Or I guess I could take that same amount and I guess either buy more shares and that same amount be earning interest.
Well, what I believe that stands for is, let's say you've told Robinhood, you said that was the company you're using, correct?
Correct.
Let's say you are going to do a ACH. You're going to move money from, let's say, your bank account over to Robinhood. So you tell Robinhood by typing in the form, okay, I'm sending $1,000 to you guys. Well, Robinhood might give you credit on your buying power for that extra 1,000, but because it's not in their hands yet, they're not claiming that you're earning interest on that money. So it's kind of splitting hairs, but they know or they believe the money is coming, but it's not there yet. So they put that in your buying power, but they don't have it set up as interest. Now, once it's there, those two numbers should be the same. Does that make sense, George?
Yeah. Okay.
Okay.
And then another question. Now they also like when I log into it, it at the end we have like a report where they got a name of a company and a dollar amount or how many shares. Like for example, I'm speaking hypothetically now.
Right.
It may say Apple, $125 a share. Best Buy, $200 a share. Does that mean if I want to purchase a certain amount or tell Robinhood to purchase a certain amount of shares, that's what it's going to cost? And then I just get added and hopefully I get dividends on whatever those shares amount to?
Yes. For instance, let's say a certain stock or ETF says this is how much it is per share. Okay. Now, I'm unfamiliar if Robinhood allows you to buy in dollar increments, but let's pretend Robinhood only lets you buy whole shares. Okay. If you can only buy in whole shares and Best Buy is selling for $200 a share, that means at the very minimum, it's going to cost you $200 of your core or money market to buy one share of Best Buy. Now, if Robinhood allows you to buy in dollar increments, and let's say you have $20. Now the share price is 200, but let's say you only want to invest $20. Well, $20 is roughly 1/10 of 200. So in that case, you would not buy a whole share of Best Buy, but you would buy 1/10 of a share. And I know for a fact that Fidelity allows you to buy both ETFs and stocks by the dollar or the shares. Vanguard allows you to buy ETFs. I mean, if the account is at Vanguard. Now, remember, at Fidelity, you can buy Vanguard ETFs and there's no commission or anything like that, which is what I recommend. But let's pretend you're at Vanguard and you're wanting to buy a Vanguard ETF. There, you can buy in dollar increments, but if you want to buy individual shares at Vanguard, not Fidelity, at Vanguard, you have to buy whole shares. Does that help, George? Anyway, so that's it. Really depends on the individual brokerage company that you're using, whether they allow some or everything to be bought in dollar increments, or if it's a certain amount. I have never personally had an account over at Schwab.
They do allow fractional. Schwab does.
Oh, okay.
Yeah.
One person told me, and this is what they told me, so correct me if I'm wrong, but they said at least in their account, they're allowed to buy $5 increments, but not $1 increment. Is that what you've seen or not?
It probably depends on what you're getting, but I know with some of the things that I've done with them, I can buy in dollar amounts.
Oh, okay. So it doesn't have to be in $5 increments.
Not
correct?
anything that I've seen.
Good. Yeah, that's what one person told me, and so, but I've never had a Schwab account. I have had accounts at Fidelity, and I have had accounts at Vanguard, so I'm more familiar with those two. I have used other brokerage accounts. But yeah, if you're at Vanguard already, or Fidelity, or Schwab, if they're giving you commission-free trades and you're getting access to ETFs, etc., especially if you can buy in dollar increments and you like it there, I would say stay there. If you want to change, any of those three are generally recommended. I would say out of the two I know, the Fidelity and Vanguard, I'd say the customer service is better at Fidelity because Vanguard simply got swamped due to their success. But the products are better through Vanguard. So the best of both worlds is to have an account at Fidelity, but use the ETFs from Vanguard.
May I say something on that?
Yes.
So I did that. I followed your advice and I love
Okay.
it. I have my account in Fidelity and I purchased Vanguard. And I have to say, just to let you know, you can talk to them. They don't have an accessibility number directly. So what they have to do is that you have to tell them you need accessibility, whatever it is, voiceover, and they will get you in touch with somebody. Now, I personally went through 3 people because 2 people just they didn't get me, and I was like losing, I couldn't do stuff. And now I got this third person, and he and I are on the same page because it's like, just tell me where to go and I'll do it. I'm quick, I'm fast, but I just don't know what I'm doing or where to go. And there is a problem with I'm still learning it from him. So we have an appointment. We made an appointment, like we're gonna do it every 2 weeks to learn stuff. And he's taught me just in a few minutes. He's taught me things that I can do on my own that I didn't even know existed on Fidelity. I'm still learning what is there and what I can do because I'm doing accounts for my mom as well. So he's really great and he's helping me to be independent. And just to let you know, because I purchased some things, like I was on a pattern to purchase things, dollar cost averaging. But then because I didn't get the difference between investing and trading like I do now, I saw something was kind of low, so I wanted to buy it, which I'm kind of glad I did. It did my dollar cost, my cost basis lower. But I purchased that and I wasn't sure exactly what I was doing. And one time I made a mistake. So I was like, okay, not a big one, nothing big. But I told him, I said, I needed help with trading. So now currently I can call up and they will help me and not charge me. Because if you get help making a trade, they charge you a commission. But if you have vision issues and you can't do it, and the grid, I still haven't managed the grid myself, and I have to learn if how that's possible. but I am now on the track that I can do my own trading by calling up and saying, listen, I want to do this. And they will put it in for me and not charge me. So that's really helpful. But if you start doing it yourself, and he told me, he says, if they see that you're doing trades on your own, then they're going to say you don't need them, if you're doing it on your own. But for those people who are unsure or not sure because, I don't want to I think I have everything done the right way and then I don't. I'm currently set up to be able to call up on the phone and do it without any commission. So that's a benefit, I think, of Fidelity.
Okay, let me break down some of the things you said because you gave a lot of info. So let me unpack a little bit of that. What Lisa was describing is an account over at Fidelity. And what she's describing is an accessibility department. They have a group of people that literally will help you trade or even trade for you with you on the phone if you need help to that level. Now, Fidelity has a great website and app. You can actually download their app. It rates very high. It's around 5.0 or 4.9. And I've helped many blind people, both total and partial, set up accounts on Fidelity or the web or whatever. Um, Personally, I have never used the accessibility department, but from what I understand, let's say if you're unsure and you don't feel comfortable, what you can do is you can call, and Lisa can correct me if I'm wrong, but you basically explain to them that you have vision issues and ask if somebody from the accessibility department can call you, and they do. And literally, I've had some people say, yes, they were willing to give me all the help I needed with JAWS and et cetera, et cetera, et cetera. And they were willing to spend hours just with me. And I thought that was great. Again, I do not have personal knowledge of the accessibility department, but yes, if you call and ask for this accessibility department, they will call you back. Now,
Wait, let me just put a
sure.
caveat to that. You have to tell them that you want the accessibility department. You have to say, I need the accessibility department for my vision. Could you? And what they will do is they will email the accessibility department to call you back, so you don't get them on the phone immediately, like some places. Like if you call Amazon Accessibility and all, they're right there. So just to let you know, they get back to you.
Okay. And now, if you're doing trades yourself, either using, say, an app or the website, there's no commissions. What Lisa was mentioning is, let's say if you're wanting to speak to a person, but you do not identify that you have vision issues, yes, I believe Fidelity and many other places charge a commission on that. That is why, if that describes you, not only you have vision issues, but you actually want to have a person do the trade for you, then that's when the fee is waived, the commission is waived. Or, like I say, many of us who are familiar with either apps or computers, we just do it. The form on the web is very, very simple, I think. But again, it's your personal preference. So don't feel like that's a valid excuse. Oh, I'm not sure I can do it, because no matter whether you are comfortable with the web, whether you are comfortable with an app, or whether you are comfortable with having a person actually do the trade for you, as long as you identify that you have vision issues, then all of those fees are waived. So don't use that as an excuse. Okay, any follow-up questions or any questions otherwise?
This list that I'm looking at that I was telling you about, like I'm looking at it right now. They
Okay.
got Tesla saying 306,078 cents. Nvidia, $173. Apple, $214.
Yeah,
$2.
that's a share
Now,
price.
share
That's their
prices. Who set these prices? The company set it themselves, and that's
no,
what.
no. Okay, what happens? That is basically the market deciding, and you say, who's the market? It's you and me and everybody else. If there are more people wanting to buy, let's say Apple, then the price of Apple goes up. Or let's say Apple has very good earnings. Let's say they sell 1 billion iPhones. And everybody says, wow, we were only expecting them to sell, 100 million, but now they're selling 1 billion last quarter. That would also make the price go up because if people hear that, a lot of people will be buying shares of Apple. And so that will make the price go up. On the flip side, if those cases are reversed, we thought they were going to sell 1 billion iPhones, but they only sold 10. Well, expect the price to drop because everybody's going to flee for the doors. Not everybody, but yeah. And so again, when you're dealing with individual stocks, you have to think a lot differently than an index or an ETF because literally now many big companies have a low chance or low odds of going bankrupt. It has happened, believe it or not, even back between 2000 and 2010, we had several large companies. One was actually in Texas and one was in Mississippi, one was in Texas, and there might have been others, but they completely went up in smoke. And that was, I believe, early, a little after 2000. But yeah, so the size, even on a big company, it's rare, but individual stocks can decide to just go out of business. That is very low odds of happening with a basket of 500 to 1,000 stocks or more. Now, that brings up a good point. Are all okay? We've heard you say exchange traded funds, ETFs. So that means if I just go to a brokerage company and say, "Hey, I want an ETF," can I do that? No. All ETFs reflect what is in the ETF. And unfortunately, now, way back in the beginning, say from 93 all the way up to, I don't know, 2010 or so, the ETFs were based on indexes. The expense ratios were low. But everybody was, as the investors were happy and they're getting more happy, but who didn't like it? Well, regular mutual fund companies, because see, they lost a big part of their revenue for decades. They've been legally stealing from investors. Well, they didn't like it when investors got smart and decided, hey, we're going to buy the low cost ETFs. So what they've decided, and especially has gotten worse since 2020, we know investors like ETFs, but we don't think they're that smart. So we're going to make managed ETFs. Now, so let the buyer beware. If you are just thinking all ETFs are the same, they are not. Some are index based, some, unfortunately, are managed, and these mutual fund companies or big banks are throwing these ETFs out into the public as fast as they can because they're hoping that investors will be fooled to buy one of these products because remember that increases that company's revenue, meaning the mutual fund company or the big bank. So what are some guidelines? Well,
Could I just
earlier,
mention
yes,
one thing?
Sure.
Because I was very confused on this in the beginning because I'm like, well, how do you make money? Because I didn't know the difference between trading and investing. So that these companies in these ETFs, they provide dividends. So you're making money on the dividends if you're reinvesting them and buying more shares. Is that correct? Am I correct in saying that?
Okay. Basically, and this applies to mutual funds or ETFs or even like George was talking about individual stocks. Let's say if you own a company or 10 companies or 1,000 companies, if those companies pay dividends, okay, just like a bond paying interest, you receive a fraction of the total dividends those companies pay. Okay, if you're holding the individual stock. Now you say, well, what if I have the S&P 500 and there's 500 companies and half of them pay dividends? Well, technically what happens is the companies that do pay dividends send it to the provider. Okay, let's just, as an example, let's say the Vanguard 500. So Apple, let's say, if they have a dividend once a quarter, they'll send the dividend to Vanguard. And Vanguard counts up all the dividends and then once a quarter disperses those dividends to anybody that holds shares of that particular ETF. Now, you have two options. You can either take the cash and run, i.e., don't reinvest, just put it in my core money market, or you can say, no, I want to automatically have you guys, don't give me the cash, give me a fractional share. And that's called reinvesting the dividend. And those are your two options. Does that make sense?
Yes. Thank you. Just wanted to be clear on that. Yeah. So in the investments, you're making money on the dividends, because it's different than trading.
You're also making money when the share price goes up. For instance, in my example a little while ago, let's say that everybody thinks that Apple is going to sell 100 million iPhones last quarter, but the quarterly report comes out and they said, oh, we sold 1 billion phones, not just 100 million. Well, now everybody around the world is going to say, oh, we want to buy Apple shares because they're doing better than we thought. That will make not only, say, if George owns Apple directly, Apple will increase, but let's say if you own Apple inside of an ETF, that will increase also. So it's two things. You get not only price appreciation, but you also get dividends. So price appreciation and dividends. Go ahead.
So then you would so if you're rebalancing and that one happened to be high, then you would just sell that one and then buy something low in your 1/3 situation.
Yeah, you're talking about the ETF. So if you had three ETFs and let's say each one you wanted to be 1/3 of your total portfolio, and let's say the domestic ETF were the most over or the biggest percentage, you would sell some, not all, but you would sell some of the thing that is most over and buy the thing that is most under to get it back in balance. And what does back in balance means?
Thirds.
Roughly, yeah, in this example, a third. Does it have to be all three parts equal? No, it does not have to be. But once you set up your targets, which is what I'm calling, 1/3, 1/3, 1/3, that's your target. So you try to stay as close to your target as you can.
Thank you so much. Thank you. I appreciate it.
Now, let's go back to the thing of, are all ETFs the same? Unfortunately not. Over the last few years, mutual fund and some big banks have been cranking out managed ETFs because they think investors are not wise to their ways. But you guys are all intelligent, and you guys know to look number one for we want an index ETF. One, because the fees, the expense ratios are lower. The turnover is less. What does turnover mean? That means if a company is buying and selling and buying and selling and buying and selling, then somebody has to pay the taxes. An index has very low turnover. So, for instance, in my example of the total U.S. market, turnover is very, very low because literally, well, even if it starts as a little baby company, even if it grows up, it started in the index, it's still in the index, there's no selling, so therefore there's no taxes that you owe, but you've been gaining the appreciation the whole time. Now, in addition to managed ETFs, which for most times you would probably want to avoid, there are other providers. They're coming up with all sorts of ideas, but they say, oh, let's take Tesla or Apple. Let's say if Tesla is very volatile, that means they might go up or down by 5 or 10% per day. Let's make an ETF that does twice whatever Tesla does. So if Tesla goes up 10%, this one ETF, now inside this ETF, literally there's only one company. Okay. So in this example, Tesla is the only company inside this ETF. This is not a good ETF to buy. And you say, well, how do they double what Tesla does? They are using what are called options. And for that, the expense ratios are higher. And unfortunately, when Tesla, let's say, goes up 10%, the price might go up close to 20%. But when it goes down 10% because the fees are working against you, you actually lose more than double. So rather than trying to figure out, well, how many individual stocks or bonds are in an ETF, I've got a simpler way, an easier way. Number one, when you're thinking about an ETF, try to only get ETFs that have at least $1 billion of assets inside the ETF. And that term, just in case you see it on the web, is usually abbreviated AUM, which stands for Assets Under Management. If you're looking at an ETF and let's say it only has 50 million in it, I would personally recommend avoiding those. Stick with the ETFs that have at least $1 billion or more for several reasons. One, the trading costs, the little frictional costs are much lower. Okay, that's number one. Remember, commissions are pretty much zero if you're at a decent brokerage company, but the little frictional costs, like a penny per share, that kind of thing, those are less. Internal trading is less. The expense ratios are less. The less you pay in fees and costs, the more you actually make in the end. And that's the whole goal of investing, is for you to gain the money, not you take all the risk and let the other company make the money from you. That's not what I'm wanting to do here. Okay.
Okay,
so, yeah, go ahead.
We got about 5 minutes left, guys. I notice the time has gone by fast. Darryl, we do appreciate you taking time and sharing it. So I just wanted everybody to know, if anyone else, and Lisa, I do appreciate you chiming in as well. You make some great comments and suggestions as well. Anybody else who have not had a chance to speak and wants to ask Darryl a question, go ahead and take this time now, or we got about 5 minutes left. Other than that, Darryl, you can continue if you got something else that you want to mention within the
Okay,
last.
let me mention two things.
Okay.
One, over on ACB, for any of you guys that are not familiar with ACB, they basically have a weekly schedule, and the first and third and fifth Saturdays of the month, I have a 1 hour session over on ACB. It's all free, by the way, but in order to have the Zoom link, you have to sign up for their weekly schedule. So literally every day they email you a schedule of what's coming up for the next day. So mine are on, like I said, the first, third, and fifth Saturdays of the month. So anyway, if you're on that or don't know about it, I think
At
you
what
can.
Time?
My class is at 2 Central, since we're on Central Time in Houston right now. My class is on the first, third, and fifth Saturdays at 2 p.m. Central, but in order to get the link, you have to be subscribed, which is free, to the ACB community. And that email, George, do you know that? Or I don't know if I should basically send an email to community@acb.org if you want to sign up. And there's more than just my event. There's dozens of activities throughout the weeks and months. The second, George, should I give out an email address or not?
Sure, go ahead.
Okay. If anybody wants to contact me, my email address is investingacb@gmail.com. Investingacb@gmail.com. And just remember, that's investingacb. Just make sure you don't type in ABC. That's the network. So it definitely wouldn't go to me. Investing ACB, American Council of the Blind, @gmail.com. Okay, George.
Okay, sounds good. All right. Any last minute thoughts, anybody? We got 2 minutes.
Questions?
George, somebody with a 619 area code has a hand up.
Okay, that's in San Diego. San Diego, you have a question?
Yeah,
Unmute
Darryl,
yourself.
hi, this is Cindy. A very quick question. Thank you, Lisa, also for that information. I didn't know this, but if you have an ETF and you're getting dividends and they send them to you, I always thought they were automatically reinvested. Then you, of course, would owe taxes on the dividends that they send you, correct?
It doesn't matter whether you're reinvesting or not reinvesting. If it's in a taxable account, all dividends are taxable, whether you have that sent to your core or extra shares. If it's in a non-retirement account, that is a taxable event. But if it's in, say, a retirement account, whether it be an IRA, 401, etc., those are not taxed as dividends. Those are only taxed when you're actually cashing any money out of the plan. So that is completely different. So as far as individual dividends, you are not taxed inside a retirement account, but outside of a retirement account, it doesn't matter what you do with the dividends. Even if you're reinvesting, that is a taxable event.
Thank you, Darryl.
Okay.
Answer my question. Thank you.
All right. Well, listen, Darryl, I do want to appreciate you taking time again to unveil your knowledge, your strategies, your information. It has been, so much knowledge here. We're going to get with Michael and see if we could probably have you back again, because I'm sure there's a whole lot more that you could have presented, and the 2 hours just does not seem to be enough.
I am glad to serve the community. Glad to serve the community and glad to serve iBUG.
And remember, guys, his email address is Is it investment or just invest?
Investing, ing.
Investing ABC at gmail.com.
ACB.
Oh, I did this. I did the thing that you told us not to do.
Yeah.
Investing ACB at gmail.com.
Yes, and spelling does make a difference on email addresses.
Absolutely. INVESTINGACB at gmail.com.
Yes.
Got it good. All right. Well, thanks again. Thanks everybody for tuning in and chiming in. We will probably have another chapter of its iBUG's life probably in September. Watch for the iBUG announcements. And you guys enjoy the rest of your evening. Goodbye, everybody.
Good night.
Bye-bye.
Thanks, Darryl. Appreciate it.
Thank you.
Thank you very much.